Hello and welcome to Global Insights with me, Punita Kumar Sinha. My guest today on the show, Mohnish Pabrai of Pabrai Investment Funds, needs no introduction. He's one of the most well-respected, value-based long-term investors based in the US. His understanding of market psychology is followed by many in financial markets. Thank you, Mohnish, for joining us today. It's great to have you on the show. So, Mohnish, we've seen quite a lot of unexpected political and economic events happen this year. How does that change your investment view? Does that change how you're thinking about the markets?
Well, the short answer is it doesn't change anything about how I invest. In fact, someone was asking me about the ascent of Trump and President Trump and how that changes things for me. And I was just saying that in my 22 years of investing through the Bush administration, Clinton administration, Obama administration, now Trump administration, nothing in Washington, D.C. That has ever happened in 22 years had any impact ever on any decisions I've made on investments. And so certainly anything that's happened recently has had no impact. And of course, we've had a seismic event in India as well with the 500 rupee and 1,000 rupee note being taken out of circulation. And I think that is going to deliver some significant tailwinds to the Indian economy in the long run. But again, it doesn't. I don't invest based on these types of factors. But I think a number of businesses in India will have better futures as a result of these actions.
Great. We'll come to India later, but just focusing still on the U.S. So you said that the U.S. elections does not really impact your investment view, or any election for that matter. How about what the Fed does? Does that impact how you think about investments?
Well, we are at something like 35-year lows on interest rates until very recently, and of course, it doesn't take a rocket scientist to guess that interest rates may be higher a few years from now than today. But that has no impact on the type of investments I'm looking at or what I'm investing in. I think for most businesses which are borrowing money, when interest rates are going to go up, obviously their earnings are going to take a hit. But usually rising interest rates mean that the economy is doing better. So it may cancel out. And I think the thing is that for most businesses, micro factors around the business almost always trump the macro factors. And so what investors are best off doing is not really spending a lot of time on who's the president or what interest rates are going to do or what unemployment's going to do, but focus more on the specific business that they are looking at and just the future prospects of that business. And if you really focus on different businesses, you'll find that the micro trumps the macro.
I guess that's the way you are investing. But the market volatility is obviously not indicative of the fact that people are just looking at long-term and being patient, because the market volatility is signaling that people are very confused and the financial markets are quite nervous. What's your reaction to that?
Yeah, so, Ben Graham said that markets are there to serve us, not to instruct us. So I don't look at market volatility to guide me in terms of what I should or should not do. Volatility is the friend of the investor. So if the volatility leads to more attractive prices when we are buying, that's wonderful. And it leads to higher prices when we are selling, that's wonderful. And so to the extent that volatility helps us, we can take advantage of it. And otherwise, we don't need to do a whole lot. We can sit on the sideline. So for the most part, I think that, like I said, investors are better off focusing on these specific business factors around that business. I mean, if you're looking at, for example, an investment in McDonald's, whether or not they offer breakfast 24 hours a day or 16 hours a day has a much larger impact than what the unemployment rate is or what interest rates are or who the president is. And or whether their restaurants are clean or not has a greater impact, or whether they have more competition from other restaurants. So it's really the factors around a given business that investors should focus on, and that's what we focus on.
But of course, there is a view that President Trump is going to be putting a lot of stimulus into the economy. He's going to shut down, immigration, and that'll be good for manufacturing in the U.S. And that this could also be inflationary, and there could be wage pressures. So yes, while McDonald's, whether it serves for 12 hours or 24 hours, more important, but then their costs might change by certain views that and certain actions that presidents take. So what's your take on what President Trump might do that will affect businesses in the U.S.?
Yeah, so, I wasn't much of a fan of candidate Trump. I am a bigger fan of President-elect Trump. And so I think in general, we have to heavily discount what folks say on the campaign trail. I mean, this is a global phenomenon. We see that in India, we see that in the U.S. And so I think, like, for example, while he was a candidate, he said he was going to get rid of Obamacare. Now he's walking that back. While he was a candidate, he said he's going to get rid of NAFTA. I actually don't think it's possible for him to get rid of NAFTA. So I think what we're going to find with President Trump, even though I didn't vote for him, as I analyze the way things are unfolding, I believe it may be the very best thing that happened to the U.S. and the world that we have President Trump as a president. And the reason I say that is it's very likely that he's a one-term president. It's very likely that he is not going to seek another term when he's 74 years old. And he is not in there for anything else other than legacy. And we have had a number of presidents in the past in the U.S. who have never run a lemonade stand. And I actually happen to believe that the experience one gets from running a lemonade stand can be quite useful in running a country. And so I think President Trump understands quite a bit about the way business and the economy works. He definitely understands a lot about construction and building. So I believe that when the U.S. government embarks on their stimulus and infrastructure build out, I believe he's going to hold his people accountable. And I believe they will actually build out stuff that will be very useful. One of the things that Larry Summers, the former Treasury Secretary, has advocated for a long time is massive stimulus spending on infrastructure in the U.S. given our low interest rate environment. And I've found a lot of sense in what Summers has said. And actually, that's exactly what President Trump intends to do. So I think that it's the best possible medicine for the U.S. economy. I think it's good news for the global economy. I don't believe much of the rhetoric on the immigration side. I believe President Trump is going to be pragmatic because he's going to care about growth. And I believe so. Immigration, I believe he will encourage immigrants who have a lot of skills to offer to the country. I think that will see a step up. So I think a lot of the issues Silicon Valley has with the lack of H-1B visas, etc., may actually get addressed because we've got all three branches of government in sync. Basically, we've got the Senate, Congress, and the president all in the same party. So they might get a lot done on that front, which would not have happened in a Clinton presidency. So I think on balance, even though it doesn't affect my investing decisions, I think we're going to get some tailwinds from President Trump.
Great. Is this a good time to be a value investor, given that the valuations across the broader market are not that compelling?
Well, it was a better time to be a value investor in December 2008 and March 2009. That was a awesome time to be a value investor. So in general, when indices are sitting at levels where they're sitting today, it's not the best time to be a value investor. But I invest in anomalies, and in auction-driven markets with more than 50,000 publicly traded stocks around the world, there will always be anomalies in every market. So there are mispriced securities in every market. There are far fewer of them today than in December 2008, but it's not zero. So I'd prefer December 2008 pricing, but we're not going to get that except very rarely.
And if you compare the levels of cash you have today in your portfolio, how does it compare to the levels of cash you've had in the previous years that you've managed your portfolios? I mean, do you think there's more cash to be held now, given where the valuations are, or less cash given the growth stimulus that might come?
Yeah, so cash levels are just a function for me based on whether or not we're able to find things. It has nothing to do with what I think interest rates, unemployment, or the market indices are going to do in the future. And as things stand right now, we are mostly invested. I mean, I like what we own. We don't have that much cash. And I'm looking at one thing, for example, right now in the shipping industry, and we'll see whether or not I pull the trigger on that. But I have no problem being fully invested, regardless of what levels markets are at, and I have no crystal ball that tells me what the market's going to do. So if we find compelling opportunities, we'll put the cash to work. And if we can't find it, we'll hold the cash. And it's just as simple. It just so happens that right now we have more, you can say, I wouldn't say more ideas than money, I would say, but probably ideas are matching the money.
So in terms of the portfolio exposures you have quite a lot of autos that I've noticed. And I believe you've also recently been buying some commodities. Can you shed some light on what else you like and where your investment view is taking you?
Yeah, I don't like to talk much about my portfolio, but the funny thing about my portfolio right now is I've always hated the auto industry because it has all these issues with high capex and unions and consumer taste. And in spite of all that, I just find, lo and behold, we have a huge, probably something like half the portfolio is in autos, which is, if you told me that 5 years ago, I wouldn't have believed you. I also have a significant position in the aviation industry, which again, if you told me that our 13F just came out and it shows we own, for example, Southwest Airlines. I haven't owned an airline in, I don't think, ever. Again, to go into these businesses where the dumbest competitor sets your price and such. But the thing is, I think that because of all the reasons to hate these businesses, I believe markets kind of are overreacting or overcorrecting. And they have some, I would say, hidden positive attributes that will I think surface over time. So I think if you look at the Pabrai Funds portfolio today, I don't think we have very much in commodities at this time. We've had more in commodities in the past, but that's the nature of it. We are anomaly investors, and so if I look at my portfolio today, I think it just looks at the most extreme end of, I would call, anomaly investing that I've ever seen it. But that just happens to be where we found value. And but we'll have more to say about the portfolio when we don't own these names. I'd rather talk about them after the fact than while we own them. to avoid, what Munger calls commitment and consistency biases.
Just shifting a little bit on your approach, your investment approach. You obviously follow the Warren Buffett approach, but you've obviously over the years and with your experience added a couple of nuances to that approach. What would you say those are? I mean, what are the specific value measures that you started looking at that maybe perhaps other investors like Warren Buffett and Charlie Munger don't?
Well, the laws of investing are like the laws of physics, and there's just one set of laws. So whether it's Mr. Buffett or Mr. Munger, me, or other value investors, we are all operating from the same playbook. And the basic laws are that we're not buying a stock, we're not buying a piece of paper, we're buying a fractional ownership in a business. And you shouldn't buy a fractional ownership in a business unless you are willing to buy the entire business if your means allowed it. So what I mean by that is that if Apple has a $500 billion market cap, if my family had a net worth of $1.5 trillion, would I be willing to put 1/3 of the net worth into Apple? And if the answer is yes, then I should buy the stock. And the answer is no, then I shouldn't buy a single share. So that's the first rule, which is you're not buying a stock or piece of paper, you're buying a ownership stake in a business. So same thing with Southwest Airlines. If I had a net worth that was 3 times the market cap of Southwest, would I be interested in putting 1/3 of it in Southwest? If the answer is yes, then I should buy the stock. If the answer is no, I shouldn't. The second is that, which I mentioned earlier, that markets are here to serve us, not to instruct us. And Mr. Market is a kind of character who changes his mood every day. So when he's depressed, we buy from him, and when he's euphoric, we sell to him. And so these are the very basic laws of investing, and they are the same whether it's Warren Buffett or Charlie Munger or me or a number of other value investors. The differences in our portfolios come from differences in our circles of competence, because each of us have different life experiences, and each of us have differences in what we understand and don't understand. We naturally get drawn to certain industries or businesses versus others, and but that doesn't have much to do with the laws of investing. So if there's a bargain available, and if you recognize that bargain, if it's within your circle of competence, then you'll act. And different people see different bargains, and that's why we see differences in portfolios.
So would you ever buy consumer stocks given their valuations?
I mean, as long as I actually do have, like for example, we own a Chinese company that's it's a consumer packaged goods, if you will. I mean, as long as the business is within my circle of competence, and as long as I perceive it being significantly off from its intrinsic value, sure, we'd be interested. I'm just not as good at consumer packaged goods because I haven't done much of it in the past, as I am in some other industries. But if something got mispriced enough, even someone like me might recognize that and might step in.
Mm-hmm. So now just shifting to India, because you do also invest in India, and at the beginning you said that you think there are quite a few tailwinds with this demonetization for certain businesses. So what is your view on India today, and how does that look to you versus the US and other parts of the world?
Yeah, so one of the things that happens is that public companies in general, and I'm you should take my views as being from a guy sitting in California. I certainly don't know the Indian markets as well as many others, but but public companies in general in India deal far less in black money and cash transactions than private businesses do. And so to the extent that public companies in India compete with private businesses, the current actions that the government has taken are a net positive for the players that don't deal in that. So the cost of doing business for some of these private operators dealing in cash, etc., just went up significantly. The cost of borrowing went up for them. They have a whole bunch of things that have been made more difficult for them. And on the other hand, the public companies will probably see borrowing costs come down because right now, I think last I saw that there had been like $44 billion that had entered the Indian banking system just in the last few days. And so that is definitely going to give a shot in the arm to Indian banks, and it's going to promote lending, and it's going to promote drops in interest rates. So that's great for the public sector borrowers, if you will. So I think that these are some of the kind of direct impacts, but I think that as the economy adjusts, I mean, the average American friend I have, if I were to go to them and say, how much cash do you have in your wallet? I think the average person I know is carrying less than $40 in his wallet. And then if I ask them next question, which is how much cash do you have at home? They would look at me very perplexed because they'd say, I don't have any cash at home. Whatever I have is in my wallet. And so even individuals in the U.S. who have net worths in the millions may have less than $100 of cash with them. And so we are very used to operating here in the U.S. in a completely cashless kind of digital economy or a digital payments type of infrastructure, if you will. And India is going to kind of get I would say, shock treatment trajectory towards that path. And the answer in India, if I asked, maybe 6 months ago, if folks were willing to be candid with me, if I went to the average kind of private business owner in India and asked them how much cash do you have in your wallet, it'll be certainly probably more than $30, $40. And if I asked them how much cash do you have at home, if they were willing to be candid, there'll be another significant sum. And so that is going to change, and it is not going to change for everyone clearly, but it will change for some people who are going to realize that things just work better if you work within the system. My general sense is that this particular action by the government is going to cause long-term behavior change in more than just a few people, and some of that can rub off. The South Korean economy was an extremely corrupt economy, and then they had a major crackdown on corruption in the 1980s and early 90s, and today the South Korean economy, corruption is more the exception than the rule. And so I have the utmost confidence that when we look at India in the 2030s, it will appear quaint when people in 2035 look back 20 years and say, wow, that was a strange time when all these people had all this black money and all this stuff, and what a strange way to live. So I definitely believe that in the decades ahead, India is going to become a cleaner place, is going to become a less corrupt place, and it's going to become a place where if I ask the question, how much money do you have in your wallet, that number is going to go way down. And we're also going to get to a point in time when people are not going to have cash at home.
During this painful time, there's going to be ample opportunity to find value, and you would probably look at investing more in India.
No, what I said is that I never make decisions based on these types of factors. I would just say that the India story just became a lot better. Whether it actually changes my behavior in terms of more investments or certain investments is a different question. I think because the threshold we have is so high, if the Sensex dropped by 50%, definitely I would have behavior change towards India in terms of what I'm buying or not. But if the Sensex drops 5%, it has no impact. So we haven't seen anything significant in terms of indices from that vantage point. But I would just say that the investments we do have in India just got a tailwind that they didn't have before, which I had not counted on. And so we are very happy about that. And I think their intrinsic values went up, which is great.
Okay, great. On that note, thank you very much, Mohnish. It was a pleasure to have you on our show.
It's a pleasure, and all the best. I love your show.
That was Mohnish Pabrai speaking to us on his views on the US markets post-elections and what he thinks of India after demonetization. Thank you for watching Global Insights with me, Punita Kumar Sinha, on ET Now.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.